Welcome back. Well, just about consolidating with a little bit of a positive bias at this point in time. Looks a bit tentative for the markets, just about high by around 30 odd points. Let's see whether that sustains or not. But in the meantime, let's in fact focus on Suprajit Engineering. They have made a new acquisition in Germany of a light duty cable maker. And this is out of insolvency proceedings in Germany. We have Mr. Kumar Rai, who is the founder and chairman of the company, who's joining in to discuss more on this particular acquisition. Mr. Rai, if you could just start by giving us a sense about this company, SCS. You're buying it out of insolvency proceedings in Germany. It has an enterprise value of around 13 million euros. Give us a background in terms of what this company is bringing to the table. If it's in insolvency proceedings, what is the kind of valuation that you bought the company at? Is it a distressed sale? What are the revenues as well as the margins and the profitability of this particular company that you're buying?
Good afternoon, and thank you for having me on your channel. Just to give a background, Stahlschmidt Cable Systems, SCS as we call, is a group of companies headquartered in Germany, but having plants in China, Morocco, Poland till recently, as well as some amount of production in Canada. It's a 100-year-old company. They're one of the leading light-duty cable makers in Europe. What they have done, originally they were all making these cables out of Germany. They decided to move to Hungary to bring the cost down. Then again, they moved to Poland to bring the cost down more. And then as the pressure from customers increased to compete with, competitors like us or from China, they decided to move to Morocco. In the process of moving multiple moves of main operating plant, they got into cash flow problems. And that's why the German company, the parent, went into insolvency due to cash flow issues. The plants are in great working conditions. Actually, the Morocco plant is a brand new plant. Plants in China is very good. So operationally, they were a good company, but cash flows were the problem. And hence, they had to go into an insolvency proceedings in Germany. And through the negotiation with the insolvency administrator in Germany, we were able to acquire this facility, acquire these assets and companies. So that's the way the whole thing happened. SCS is a light-duty cable maker for most of the leading European as well as US customers. Customers like BMW, Audi, Daimler are the big customers on a tier one, whether it is Magna, Faurecia, Lear, Vita, Grama, they're all their customers. So they have a marquee customer base and a very good, well-accepted product. So I think that made us attractive to us. What really is attractive for us is that through this process, now that there is a Morocco plant, we are able to offer our customers both onshoring opportunities if they want onshore, near-shoring like Morocco is close to Europe, and of course low-cost base if they want either from India or from China. So this makes our supply chain footprint perfect for our customers for a long-term value creation for both customers and us.
Just looking at two things then. First is that the enterprise value of this is around 13.5 million euros. And secondly, you said that this will add around 50 million euros to your overall revenue. So the first point is, how much will you be paying for acquiring this? What would be the increase in debt because of this? And when do you pare that debt down? And second part is, by when do you reach that 50 million euros in revenues?
The revenue run rate today is at 50 million euros for the group. So I expect that to be there intact when we start operating this ourselves. In terms of the enterprise value, you are right, 13.5 million. There are certain debts that is there which will be reduced from the enterprise value after negotiation. The insolvency administrator will be negotiating with the creditors and bringing this down. So the equity value will be lower than that. So the way we look at it is that over a period of time, because it's a two-tranche closure, first we are closing the European side, including Morocco. And on the second side, we are expecting to close both Canada and China. It's going to be a few months before we do it. that is the time we'll get a correct picture. In terms of the debt, we are not planning to take any new debt. We'll, as you know, we have got nearly 500 crores or 450 crores of cash in our balance sheet, and the requirement is much, much smaller. So it's we are not taking any debt, and there'll be no additional leveraging happening at all in this transaction.
Okay. You had an FY25 guidance of double-digit growth and margins. Is that correct for the company?
Yes, that is correct.
Does that change now because of this acquisition? Is there any kind of dilution to this guidance because of, say, integration process, because of, say, their operating leverage that you have to bring on?
What we have guided is for our current existing operations, not for the new acquisition. New acquisition will take another year or so for us to consolidate and do a necessary, streamlining of operations. So when we gave the guidance, it was prior to this thing, and this would be separately also been disclosed in our quarterly numbers as to how they are doing. Over a period of 1 year, I think it will be fully integrated into Suprajit.
All right, so we'll talk about that in a year once it is fully integrated. Just a word before we let you go. Your margins for LDC are in mid-single digits. With all the synergies and cost synergies that you bring with this acquisition, will the margins be higher than that, or will they still be in the mid-single digit mark itself?
The acquisition this one brings is, as I said, the nearshoring, onshoring, and low-cost manufacturing base, a better consolidation of vendor base, and that means at a supplier end. That gives us a leverage to discuss value for money proposals with our customers. So we strengthen ourselves by this consolidation. That is the first and most important part. In terms of the margin, I think, as you rightly said, SCD, that the controls division, is at a mid-single digit thing. We have given a guidance that will improve by itself this year, whereas this will bring additional, tailwind to us over, I think, 1 to 2 years' time.
Okay, an additional tailwind over 1 to 2 years. That's the guidance coming in. Thanks, Mr. Rai, for joining in and giving us that perspective. That Suprajit, that stock is up around 30% in the past 6 months odd. Made an acquisition. Let's see. The integration is probably going to take a year from now on. They're sticking to their guidance of double-digit growth in FY25. We'll take a short break, but up next we'll be discussing technicals. Achyutanand Udekar of Trade Bulls will join in. Stay tuned.